Well, George Goncalves is chief fixed income rate strategist at Cantor Fitzgerald. He's here in the studio with us, and he was
Julie.
looking at these headlines just as we were. So is there anything about this auction surprised you? High demand, relatively high demand.
Well, the fact that we had $3 chasing the amount of available securities up for offer tells it all. I mean, 3 times oversubscribed auctions have become more of the norm, but we have to put that in context that these auctions have become a lot bigger because we're financing a lot more government needs.
And wouldn't you think it would be tapering off at this point? I mean, not only are the auctions getting bigger, but, you know, we've had so much supply out there already.
That's right. I mean, I think there are a lot of different things that are going on. One of them is the realization that from an inflation standpoint, the government bond market is still giving you some high real rate of returns, and investors are still questioning the outlook on the economic front. And you have that in a risk market, in stock markets that perform so well. The last few weeks of the year, if you park and save cash and wait for next year to reassess your risk budget, the Treasury market will be a big recipient of that.
Now, I want to pick up on something that Brian mentioned at the end of his report, which is that the stock market and the bond market are telling us different things right now. Stock investors seem to be very optimistic about the economy, given the rally that we have seen over the past months. On the other hand, if you look at the Treasury market and the buying that's been going on there, that seems to express more caution. So what's going on here?
It's not, again, it's not as clear as that. I mean, the bond market or the government bond market has replaced, in some ways crowded out other fixed income markets which have been temporarily closed. The CLO markets, the securitization markets. Fixed income investors have less and less alternatives to buy fixed income products, so they're gravitating towards the government markets as a place to place their money until those other markets open up. So I think that is going on, which doesn't necessarily mean it's at odds with the equity market. But let's not also forget, if it were not for lower rates, the equity markets would also be coming down too. So there's a symbiotic relationship going on where low rates are allowing to fuel these other risk markets to go higher, as easy money has allowed carry trades and leverage trades to go out into equity markets, credit markets, commodities. So it's actually a good thing that rates have stayed low for those other markets.
I think Brian wants to chime in here too with the question.
Yeah, this is Brian. Look, George, the question is, what's the outlook for the next 6 months? I know you feel that rates are going to trend higher according to your forecast. Now, what is that driven by? What's your biggest fear in the next 5-6 months? Is it inflation or is it deflation? That's what could be driving this market down a little bit lower than some had thought.
I think seasonally until the end of the year, my official rate call is still 2.9% on the 10-year note, which is a lot further lower in yield from where we are now. When we turn the corner, I mean, the seasonals start to matter less, and people start to have a reassessment of the 2010 outlook, and that will probably drive rates a little bit higher. But my forecast is no runaway rise in rates. I'm talking about 3.5% 10-year notes sometime mid next year. That is in relation with a stable growth environment. If the bond market is actually moving quicker than that and surpasses my 2.9% 10-year forecast at the end of the year, then it's telling us that there's a concern about the economic viability and the sustainability of the recovery. Right now, I think that there's some mixed signals going on. It's not necessarily one outweighing the other. It's just that everything's happening at the same time with less competing fixed income markets.
Well, and I guess, too, what Australia did isn't really affecting what people are thinking that the Fed may do.
Right, and the Fed has a lot, or the issues that we're tackling in the U.S. are different than what the Australian Central Bank, being an export-based economy, being a commodity-based economy, relative to what the U.S. has to deal with, which is an over-leveraged society with a lot of need for low rates to kind of cure the ills of the last 5 to 10 years. So keeping rates low is definitely in order for the next couple of years. And I think that, low is a relative term of, is it 0, is it 1%? It's still a nominal level that's easy to finance our debts.
What about the other factor you talked about, these other interest rate markets? When might they now again become more attractive for investors, and will that put some pressure eventually on treasuries?
Well, the government initiatives from PPIP and all these other measures are trying to open up these securitization markets so that investors come in and not just the government's forcing their hands. At that point, I think it would be welcome among all market participants to see CMBS do well and real estate to cure and to evolve. But those are multi-year issues that are going to be with us for a long time, benefiting the Treasury market.
Hey, George, this is Brian Luke again. This particular auction was a $20 billion auction, tacking on to $46 billion. So this made it the biggest note out there. Now, how much bigger can the U.S. Treasury market get before investors demand 4% yields, 3.5% at least % yields on the 10-year?
And we just have about 20 seconds left.
Sure. We should look back at the Japanese experience and realize their debt to GDP ratios are well over 100%, and the U.S. total government debt to GDP ratios are under 100%. We can continue to grow auction sizes without really derailing the interest rate outlook.
Okay, George Goncalves of Cantor Fitzgerald, thanks a lot. And our Brian Luke, thank you very much as well.